Yeah.
All right. So last week we talked about some things to consider as the tax year comes to an end. And one of those things was making sure that you understand when your RMD goes into effect. Even Ed Slott, an IRA expert, says RMD rule changes are confounding even to many in the financial industry. So what do we need to know, Brian?
Well, I mean,
first of all, let me make sure required minimum distribution. I got it right?
You almost got it.
All right.
Yeah,
thanks.
required.
And concrete assets, right?
Yeah. Yeah. If you have any concrete assets, you can put them in your IRA. Also,
nobody likes you.
You can invest your concrete in an IRA and watch it
I'm never going to hear the end of this, just so y'all know.
You'll watch it grow substantially all the way to the bottom of the lake.
Cool.
So the RMD is a little confusing, but it's required minimum distribution. So it's got these fancy rules. You know, it used to be 70.5, then it was when you're 72, now it's 73. So once you hit 73, let's assume that you have $1 million in your IRA.
Okay.
And you're not working, right? Because you don't have it in your 401. You better not be working at 70. We'll make sure we get you retired.
Or doing something you want to do.
Yeah. But let's say, you retired, you moved it to your IRA and you're investing it and whatever. And you're supposed to take out money. You're going to have to take about $36,000 a year from your IRA that year, not per year, in that year.
Yeah.
But what we don't know about this, this example is that they also have $1 million in a after-tax account that's invested as well. Maybe it's in dividend stocks, or maybe even have some rental real estate that's paying you cash. You're making $60,000 a year from this portfolio, maybe in rent. You got the $1 million in the taxable account. Do you really need $36,000 to come out of the IRA and pay tax? No, you don't. So where the biggest asset managers, the difference between an asset manager, stockbrokers, and financial planners. Everybody in the financial industry is called a financial advisor. Absolutely drives me nuts. Oh, yeah, my brother, my sister, my uncle, my friend, my best friend's roommate that I used to go to high school with, they're a financial advisor. Everybody's a financial advisor, but no one's actually doing tax planning. I shouldn't say no one, because I know a lot of good tax planners. There's a lot of good ones out there. But the majority of them are focused on managing the assets, investing in the stock market, right? Whatever it may be, gathering more assets from new clients is their goal. So tax planning is where you look at the whole situation and look back on, you are going to get hammered in taxes down the road. And people go, well, I don't worry about that later.
They're going to tax that asset.
Yeah, they're going to be taxed, and then they're going to be taxed, and it increases. The percentage increases every year because you're getting older. It's based on life expectancy tables. So if you want to pay more in tax, that's fine. Do nothing. It's fine. Do nothing. I mean, you have a choice. You can do nothing, give more to the government. That's great. Do that.
That doesn't sound like a good choice. That's the choice.
But that's what people do all the time.
I know.
95% of people are doing that. They're not doing anything about it. They're not. So my thing is like, look, we can try to figure out, you got these other assets. You've got other things you can purchase, real estate. There's other things that we can do to help bring more tax deductions to help allow you to convert more IRA to a Roth. Because the problem is if you convert, let's say you convert $200,000 of your IRA to a Roth, and the guy's, someone's making $100,000 in retirement. Not exactly, but just use easy math for me, right?
Okay.
Let's say they're
200,000. All right.
Yeah, they're gonna do you might pay, just for easy, you're gonna pay probably $60,000 in tax, probably 50 if you're in Virginia.
So 30%.
If you're in a state that has about a 5% tax bracket. Now,
Okay.
if you're in Texas or Florida, you are a very smart person and you don't have to pay the tax, right? If you're in California, well, yeah, you're paying more tax.
Yeah, no doubt.
So you are paying $50,000, but what if there's a way to help do some other things to offset that tax? Could be charitable contributions, charitable gift planning, could be cost segregation on a real estate purchase, going into passive real estate to be able to get some losses. There's a lot of things you can do to help. If you have a business, maybe that's the year that you're making a lot of large purchases to get bonus depreciation. Business owners know about bonus depreciation. Now it's only at 80% this year, But it's all about the timing of everything, right? And that's why we're so busy this time of year, because we got business owners going, Brian, I am going to get killed in taxes. I'm like, yep. And you got 2 months to figure it out.
Jeez.
And if you wait another month, you're not figuring it out, because there's not a good tax planner in this town or in the country that's probably going to be able to do anything that fast. So you need to get on the ball and create a tax plan that says, here's my estimated taxes, right? Here's what I'm gonna owe. The RMD rule is very confusing, but what you need is just really a comprehensive plan to see. Sometimes they come and you're like, oh my gosh, Brandon, I need to do conversions like you're talking about. No, you don't. You're going to need that money. You're going to live on it.
They tax everything.